Hello, and thanks so much for checking out the Coin Stories podcast video page. I'm Natalie Brunell, and normally I talk to the leading voices in Bitcoin, but today I have a very special episode with one of my favorite guests talking about the big economic picture at large and whether we're headed for a major crash. He's one of my most popular guests from the past. But first, I do want to share this podcast does not provide financial advice. It is for educational and entertainment purposes only. I'm super excited to share this episode is brought to you by the Bitcoin Conference 2022. I'm so excited. I'm going to be a speaker this year in just 2 months. That event's going to be held in Miami, April 6th through 9th, and it's going to be the biggest Bitcoin event in the world. All 4 days will be jam-packed with exclusive content, exciting announcements, and an incredible lineup of Bitcoin speakers, artists, and leaders. Day 1 is Industry Day for enterprising Bitcoiners who are looking to build a business or career within the ecosystem. Days 2 and 3 are general conference days featuring speakers like El Salvador President Nayib Bukele, who has promised a big surprise at the event, as well as CEOs like Michael Saylor, Elizabeth Stark, Jack Mallers, Adam Back, and hundreds more. The conference caps off on the 4th day with the world's first and largest Bitcoin music festival, Sound Money Fest, headlined by rapper and fellow Bitcoiner Logic. You're also going to hear from Steve Aoki, CL, Run the Jewels, deadmau5, and many more. Last year's conference sold out, and this year's is on pace to be 3 times larger. So make sure you grab your tickets before it's too late. You can head to b.tc/conference and use the code COINSTORIES for 10% off your pass. Make sure to get those. They will sell out. This portion of today's episode is sponsored by SoFi. With SoFi's all-in-one platform, you can save, spend, earn, borrow, and invest. You can buy stocks and ETFs, open an automated portfolio, or my favorite part, start accumulating Bitcoin, all with no account minimums and 0 commissions on trades. Whether you're new to the world of Bitcoin or you've been dollar cost averaging or trading like a pro for years, SoFi has something for everyone. If you head to SoFi.com/Natalie and sign up for a SoFi Active Invest account, you can win up to $1,000. Thank you so much to SoFi for sponsoring this portion of the episode. All right, there's a lot happening in the market, so I wanted to bring back one of my favorite and most popular guests, David Hunter. Now, David is not a Bitcoiner, at least not yet, but he's a macroeconomic strategist with 48 years of experience on Wall Street. Very popular on Twitter. His handle is @DaveH_Contrarian. And he's a contrarian because he predicts a massive historic deflationary bust that represents the greatest financial crisis in history. And he says it's pretty much right around the corner. Now, the United States keeps doing a good job kicking the can down the road with stimulus, quantitative easing, money printing, but the music can't play forever, right? So David says that he sees indicators that we're headed for the end of this decades-long secular bull market, which he believes is going to culminate with a melt-up rally that's going to spark euphoria and everyone pouring into the market, followed by drawdowns of 80 to 90% in this historic bust, followed by a recovery that's going to shift everybody's allocations and that could put our whole financial system in jeopardy. And the decisions you make between the melt-up to the bust to the recovery will essentially determine your financial future. So I'm dividing this interview into 3 sections because I really want to hone in on David's thesis. The first is that melt-up rally, which David says is now underway after that correction in equities we saw a couple weeks ago, followed by the bust, what signs to look out for and what it actually means and what it could look like when all of this credit starts to unwind. And then finally, the recovery and what to do in the future as you plan out the next 5-10 years of your life and how to protect yourself and your family. So really important interview. Really thank David for his time. And without further ado, here he is. Okay, well, David, first of all, thank you so much for doing this again. It's always great to have you on the show.
Yeah, thanks, Natalie. Glad to be back.
Well, we've hit so many of your targets over the last 2 years. So first, I'm just going to ask you, are you from the future?
No, not that I know of. So you get lucky sometimes.
What do you think about the current state of the financial markets that we're in right now? I know that it's hard to forecast, right? You've had to shift some of your predictions and dates. You never want to talk about specific dates. So what do you think about our current environment?
Yeah, I'm a big picture guy. So it really isn't about, precise timing. And I have expected things to happen faster sometimes. It's kind of a typical thing I run into, but it's really part of a cycle call. So that I'm calling for a melt up into a top, into what I call 39-year secular bull market top, followed by probably the worst downturn in the post-World War II era and an 80% bear market. So those are big calls. They're very extreme calls. They're, once in 80-year type calls. So there's a lot of things like that people look at and think you just, putting out big numbers. But I will say it's playing along as I pretty much expect. It always takes longer than you expect, but I think we're in the melt up phase now. We just went through really probably almost a 3-month correction. It started in early November and just ended. And I think we're on track now. We're in what I call the final melt up leg. I know there's a lot of people still out there because the last few weeks were pretty rough, still out there calling for new lows and that the markets broke down, et cetera. I don't see that in my work. They did break certain important levels, I think, but I think that was temporary, and I do think we're in that final leg. So we can get pullbacks. The Nasdaq can certainly correct a couple hundred points at any time, and the S&P can certainly come back, 50 points or more. But in terms of going back to the lows, I think that's very unlikely. It's always possible, but unlikely. And essentially, I'm saying we're going to see 6,000 on the S&P and 20,000 on the Nasdaq, probably in the second quarter. Could even be sooner, but I think to get that far, which is still a 30% move from here or more, to do that in a couple months is unlikely, even though it is going to be really fast. So I'd say most likely second quarter.
What's been your biggest surprise over the last year?
That's a good question. I think probably the metals, because they had a big run out of the March 2020 bottom, and had a big run into August of that year. I expected them to correct for a few months and then have another leg up. And they basically have been correcting ever since then. So it's been a year and a half, almost a year and a half of consolidation. I think they're beginning to emerge from that. I've thought that before and didn't happen, but this time it looks like they are. The dollar held them back a lot. We had a year-long consolidation in the dollar, upward consolidation. It had fallen from DXY had fallen from 104 to 89. We've basically had a 50% retracement, and I think we're just beginning a rollover there. So if the dollar's heading for much lower lows, as I expect, then gold and silver should get going.
Okay, I want to touch on some of those points in a little bit. And for the rest of the interview, I want to kind of divide it into the melt up, the bust, and the recovery, because as you mentioned, you're basically predicting the biggest financial crisis in our history. So let's start with the melt up. You believe essentially that it started last week. I think the bottom came in around the 24th. So why do you feel confident that we are indeed in that melt up portion of your forecast? And how confident are you that we are?
Sure. Yeah, let me just step back and say, a melt up as I define it is something that we rarely see. 1929 had a melt up. The Nasdaq had a melt up in 2000. Into the top in 2000, and you see it in individual stocks occasionally, but it's a rare event, and people use melt up to define every big rally we have, and it's not that. So we're in a very unusual period, and you could argue that we've had that parabolic melt up from the March 2020 lows. If you step back and look at a longer chart, it does look rather parabolic. So that's a question I get a lot: is haven't we already had it? Aren't you really expecting something that's already happened? And I would say, yes, in some terms, this is all part of the same melt up that started in March of 2020, but this is that final, what I think will be an even steeper leg to it. So when I say melt up, I'm talking about the slope of the rally being steeper than anything we have seen to date, and certainly anything we've seen typically in a long time. So that's for starters. why do I think it started last week? Well, we had the very sharp drop in the markets really since the beginning of the year. And after a few weeks, I guess it was last Monday, a week and a half ago now, that we hit our lows. It felt like a capitulation low. People were throwing everything out. You were having people starting to play leapfrog about how low can we go? Everybody trying to have a lower number. Those are typically the signs you look for a bottom. And then it reversed. And now sometimes those reversals are false reversals and they come back and they, go lower. So you have a lower retest or a failure. It didn't do it, but later in the week, after a few day rally, it came back, or a couple day rally, I think it was, came back and basically tested at a higher low. And I think that was the end of the correction. And we've been up strongly since. Maybe I'm looking for something because it fits my forecast, but I really believe, based on a lot of internals, what I'm seeing in groups, I saw a lot of things that looked like they had kind of throw out the baby with the bathwater type lows, and now we're starting a very strong rally. Now, keep in mind, back in early December and again in late December, we had corrections and then big rallies, and I was told I was missing my own melt up, and I kept fighting it and saying, no, I think there's more correction to come. I haven't seen the kind of correction I wanted to see. This last one was the correction I was wanting to see. So that's why the other two I fought and said, no, it can go lower again. This time, I think we really had that capitulation low.
That's really interesting. And you're right. I mean, we haven't had many melt ups in US history. I was trying to look into it, and I would say that the summer of 1929 might be one of the best comparisons. There was a move from, I think, DJI 300 to 380 in just over 2 months. And I also saw a New York Times article from October 1929 headlined, "Brokers Believe Bottom is In." And the market crashed 23%. Then it rallied 12%. But then over the next 3 years, it crashed 89%. So do you have any other, comparisons to this melt up thesis? I think you mentioned 2000.
Yeah, 2000 NASDAQ, certainly the dot-com bubble was one of those straight up moves where it just never stopped. If you were in that period, most people that are, have been around at least that long will tell you it was just unbelievable. People were, anything that had a .com name in it was bought. It didn't have any earnings. It didn't have any prospects, but boy, it got bought. And so it was that crazy euphoria you get where people are just chasing momentum. So that was another one. I think I started in the business in 1973, and I came in to what was known as the Nifty 50 top. So the S&P, at that time, the big banks were running the money, ran most of the pension money, and most of them were all based in New York. So all the money managers, all the pension managers would go to the same luncheons and hear the same stories and buy the same stocks. And it got to where, as the market narrowed, it had been a long bull market. As it narrowed, it came down to basically 50 stocks. It was the big blue chip stocks at the time, IBM and General Motors and all the big ones. And they basically went to the moon because everybody was buying exactly the same stocks and nothing else. And it reached the crescendo, and then, big story where it went through a long bear market where those stocks did nothing or except go down. So I would argue that could be a possible, defined as a melt up. So it really is characterized by, just a euphoric psychology and a belief that this will never end.
Is it essentially like having the tide, come out and everybody goes to the beach to take a look and see, and all of a sudden the tsunami is about to come and knock them over?
Yeah, I guess I've never thought of it that way, but yeah, I guess you could say that it's really a case where it becomes FOMO, it becomes, a fear of missing out. And what I don't think people realize at this early stage of this last leg is that at the top, it's going to be very hard to sell. Everybody today is saying, well, when we get there, I'm going to sell. and they use my target, but they could use anything. And they go, I'm going to get out. At the top, it's going to be very compelling to be in. I think the story is going to be that we had a slowdown in the economy, and that the Fed is forced not to tighten, but to actually ease. And that what that did was it became the kind of the pause in the economic cycle that allowed the cycle to extend for another couple of years. That's what I think the narrative is going to be 3 months from now, or 4 or 5 months from now, is that the Fed's not worrying about inflation and tightening, the Fed's worrying about a recession. And as a result, you're back to the Fed being the wind at your back, not the headwind.
Well, yeah, that's what I was going to ask you, because we were supposed to see the first small interest rate hike in about a month, but there seems to be this narrative shift from tightening to accommodation. So you don't think the tightening will happen at all anymore?
Yeah, I think it's unlikely. Obviously I don't know, but what I've argued in certainly the last month is it's not so important for my scenario, given that I think this is going to happen fast. It's not so important, does the Fed tighten or doesn't the Fed tighten? It's really the street narrative that matters. And what we've had for many months, probably going back to last summer, is this tightening narrative hanging over the market. So it was just this attitude that, the Fed's going to tighten, inflation's running. At some point when the Fed tightens, that's going to cause a crash in the market. So as a result, for months, even when the market was moving up, there was always one foot out the door, because I know the Fed's going to tighten, and I know I have to get out before they, crash the market.
Exactly. Yeah.
If that switches, and all of a sudden, hey, the Fed's got to ease, if that becomes the narrative, it's a whole different attitude in terms of how you look at the stock market. So it's really the street narrative that I think is going to shift. I still think inflation's a problem. I still think somewhere this year the Fed is going to tighten. I just don't think it's going to be in the time frame everybody thinks. And I think before we get to that tightening, people are going to abandon the idea that the tightening is going to happen.
That's interesting. Well, one of the tells for your thesis will be the dollar, right? You predict the dollar down, the euro to 130 by September, I think, but that would be an unprecedented move. So how confident are you in that happening? And would that be a driver for your silver and gold targets?
Yeah, certainly it would. I don't have a time frame on it exactly other than pre-bust. Mm-hmm. So I would say September is certainly a good idea of where it could get there. But if the bus gets delayed, the currency may run for longer. So the euro might get to 130 by the end of this year. The dollar might get to 80 by the end of this year, or it might be in the summer. I have no idea. I do think what we are in is a period where you're going to see volatility and moves that are not normal. So that's why I'm willing to say it could happen a lot faster than would seem realistic. But I have no idea. That's why I'll put time on some things, general time, not precise, but on other things, I just go, it's going to happen before the bust is my expectation.
Why do you feel like you've needed to push out the bust and now alter your forecast to an S&P top of 6,000? Like, why do you think now that will be the ultimate top?
Yeah, it wasn't so much the distance to the top. It was more the fact that it was getting stretched out. We had that slowdown last summer that bought time and stretched out the cycle, so that what I thought could have been a bust starting by the end of last year just gets pushed out. It's really, you gotta get through the melt up before you can even think about the bust. And the stock market leads the economy by many months. So if the top in the stock market's going to be pushed out, into the second quarter, then the bust is going to be pushed out into later this year. And it's possible it happens 3 months after a top, but more often tops build over a few months, so everything gets stretched. And so again, things can happen faster in the cycle, and this cycle seems to speed up everything in terms of, the volatility. Mm-hmm. So certainly, we could see a bust anytime in the second half of the year, but I'm kind of guessing it's probably closer to the fourth quarter than it is, second quarter.
There's other people obviously predicting a big crash. Some people have already taken their chips off of the table, but you mentioned, especially in a melt up, there's this sentiment of euphoria and everyone's kind of piling in. Do you think that, riding the melt up is worth the risk? Isn't it sort of like dancing with the devil, or can you actually make some money? Do you recommend it?
Yeah, that's a good question. I tell people, I'm a strategist. I'm just telling you what I think is going to happen. I'm not at all endorsing that you should be riding it or not riding it. I think everybody has to make that decision based on their abilities, their risk aversion, their sleep at night quotient. And what I want them to understand more than anything, the only thing I can tell them, or at least talk about, is that it is going to be fast, and they need to understand the risk they are taking if they are trying to play this, rather than just think, well, I'm gonna get in and I'm gonna get out. I mean, it sounds simple, but I can tell you the way psychology works, the odds are very high that you're not going to get out when you think you can look at it now and say it'll be easy for me to get out. It won't be so easy. And the other thing that I tell people is, for those that say, well, I'm sitting it out, I go, that's fine. But just understand your own personality and your own abilities to resist, because what I see a lot is people that say, I'm sitting out now, when things become compelling at 6,000, they're getting back in. So you miss the rally and you get in at the top because of the way psychology affects people's psyche. It's the emotion of the market. Like I said, what people don't understand when you're early in the rally is how compelling the story will be at the top. The top doesn't come because everybody's idiots. The top comes because it's compelling, because the story at that time looks, very compelling. Look at, in a small way, just look at the end of the year. You had that year-end rally. You were at 4,800, and people who never thought we'd ever get near that were now calling for 5,000 and 5,200, et cetera. So it's the way psychology works in the markets.
All right. Thank you to David for those fascinating insights about this euphoric melt up that could be underway, ultimately leading to a historic bust. That's what we're going to focus on in the next portion of the interview. So make sure not to miss that. Please hit subscribe and like so others can find this video, and check out part 2 of the 3-part interview coming up.